Listen carefully because this is where most people get blindsided. Barbara is 71. She lives in Ohio. She did everything right. Built her savings, paid off a home now worth $400,000. Held stocks for decades. Real wealth. Real discipline. Then life hit her son. James, 43 years old, lost his job 8 months ago. 2 kids in school, mortgage closing in, pressure building every single month. So Barbara did what any parent would do. She stepped in, a $20,000 check. Then she transferred appreciated stock. Then another $19,000 the following year because someone told her it was tax-free gifting. It felt right. It was her money. But here's the part no one warned her about. 3 years later, Barbara got sick. Hospital. Long-term care. Costs accelerating faster than she ever planned for. So she applied for Medicaid. And that's when everything changed. Because they didn't just look at her situation today, they went back 5 years. Every check. Every transfer, every gift, and suddenly that help she gave her son became the very thing that could cost her everything. Now this is where the system turns on you, and almost no one sees it coming. They ran the numbers, calculated the penalty window. And just like that, Barbara lost her Medicaid eligibility for months, maybe longer. She's already in a nursing home. She can't pay out of pocket anymore. The money she gave her son? It's gone. And James, he can't give it back. Here's the twist that shocks people. The IRS told her everything was fine. The annual gift exclusion, $19,000 per person. No gift tax owed, no filing required, so she thought she was safe. But Medicaid? Different system, different rules, no connection to the IRS. And no one told her that. This video is for education only, not tax or financial advice. Always speak with a qualified tax professional and an elder law attorney before making decisions in your own situation. Every week, I break down the tax rules, financial traps, and hidden risks that hit retirees when they least expect it. And today, I'm going to walk you through the 3 exact rules the government uses to penalize retirees for doing something as simple as helping their own children. Alright, this is where most retirees walk straight into the trap, thinking they're playing it safe. I'm going to show you why that $19,000 tax-free gift rule is one of the most misunderstood rules in retirement. I'll expose the capital gains trap that quietly destroys wealth when parents transfer the wrong assets. And I'll give you a clear, no confusion plan to help your family without triggering any of this. Here's the problem: your accountant might understand gift tax rules. Your advisor might understand capital gains, but almost no one explains how these systems collide with each other. And with Medicaid. Let's start with the illusion. In 2026, the IRS allows you to gift $19,000 per person per year. No reporting, no tax. Go above that, file Form 709, but you still won't owe tax unless you exceed a $15 million lifetime limit. Sounds simple. Sounds safe. It's not, because Medicaid plays by a completely different rulebook. When you apply for long-term care, they look back 5 years, every dollar, every asset, every transfer. And the IRS exemption? It means nothing here. Zero protection. A $500 gift can trigger penalties just like $50,000. They calculate it precisely. Total gifts divided by your state's daily nursing cost. That number equals the days you're denied coverage. No warning. No forgiveness. And no appeal just because you didn't know. This is the part that turns a simple mistake into a full financial collapse. That number they calculate? That's how many days you're on your own before Medicaid pays a single dollar. And during that penalty window, you pay everything out of pocket. Here's the danger: the clock doesn't start when you give the money. It starts after you've spent down everything and finally apply. So worst case, you give money away, burn through what's left, apply for Medicaid, and only then does the penalty begin. That's not theory. That's happening right now. Long-term care is the biggest hidden cost in retirement. Around 70% of people over 65 will need it. Over 40% will end up in a nursing home, and a private room now runs over $100,000 a year.
Medicare? It stops after about 100 days. Medicaid is the only system left, and it audits everything from the last 5 years. Look at Dorothy. She gave her daughter $5,000 every Christmas. 4 years, $20,000 total. All under IRS limits. Stroke at 72. Applies for Medicaid. Denied for months.
Now Robert. He gifted his $350,000 home to help his son through a divorce. 2 years later, health crisis. That transfer? Flagged. Penalty. Massive. No Medicaid, no home, no safety net. And this is where a gift quietly turns into a financial burden no one expected. Robert is stuck. Limited savings. Nursing home bills he can't afford. Waiting out a penalty clock that doesn't care. But it gets worse. He didn't just lose Medicaid eligibility. He created a tax problem for his son. Michael inherits the house, but not the value. He inherits the original cost basis, $60,000, so when he sells at $350,000, he owes tax on a $290,000 gain. That's not a gift. That's a liability. If Robert had passed the house through inheritance instead, Michael would have received a stepped-up basis and paid zero capital gains. Same story with Linda. She gifted stock worth $90,000, originally bought for $20,000, no gift tax, no paperwork. But her daughter pays tax on a $70,000 gain when she sells. Now here's the hidden opportunity. If Linda had sold the stock herself during a low-income year, she might have paid 0% capital gains tax, then gifted cash instead. Same asset, same intent, completely different outcome. That window exists for many retirees, but almost no one uses it. If this opened your eyes, don't wait. Because the difference between helping your family and hurting them comes down to understanding these rules before you act. This is the kind of information people only discover after the damage is done, and by then, it's irreversible. Subscribe, stay alert, because what I'm about to show you next is one of the most powerful protections in retirement, and it disappears the moment you give the wrong asset away. It's called the step-up in basis. When you pass away and leave an appreciated asset, stocks, real estate, your heirs don't inherit your original purchase price. They inherit the current market value. That reset wipes out decades of capital gains instantly. Buy at $20,000, worth $300,000 today. Leave it through your estate. Your child sells it the next week. Zero capital gains tax. But gift that same asset while you're alive. They inherit your $20,000 basis, sell at $300,000, and now they owe tax on $280,000. That's $42,000, even $56,000 or more. Same gift, completely different outcome. The rule is simple: don't gift highly appreciated assets if you can pass them through inheritance. Yes, cash gifts are fine, low-gain assets, minimal impact, large estates, different strategy, but for most retirees this one rule matters more than anything else. And one more trap: pulling $60,000 from an IRA to help your child. That's taxable income for you, and it could push your Medicare premiums higher 2 years later. Helping your family shouldn't cost you your future, but without the right structure, it often does. This is the part almost no one plans for until it's too late. Retirees think they're being responsible, using their own money, helping their kids the right way, but the source of that money, that's where the damage starts. Pulling from an IRA to give a large gift doesn't just move money, it creates taxable income, can push your Medicare premiums higher, and still gets flagged by Medicaid inside that 5-year window. So now you've stacked taxes on top of penalties, on top of risk. There's a better way, but it requires precision. Start here. If you're gifting regularly, check whether those transfers could trigger Medicaid issues. That 5-year clock is already ticking whether you see it or not. Second, never gift highly appreciated assets if you can pass them through inheritance. That step up in basis can erase decades of taxes instantly. Third, use strategic exemptions. Direct payments for tuition or medical expenses can bypass limits, but verify how your state treats them. Fourth, if your estate is under $15 million, gifting isn't always necessary. Holding assets may be far more valuable. And fifth, if you've already gifted recently and health risks are rising, act now. Planning tools exist, but they need time. Because in this system, timing isn't important, it's everything. This isn't a strategy you fix after a health crisis, it's one you build years in advance. The mistake? Thinking IRS rules are the only rules that matter? They're not. Medicaid has its own system. Capital gains has its own system. State taxes, another layer, and no one explains how they collide until it's too late. Barbara followed every IRS rule, still penalized. Dorothy gave small gifts, still flagged. Robert gave a house, created taxes, and lost eligibility. These aren't wealthy families making complex errors. These are normal people making irreversible decisions. Share this before someone you love makes one. Because once it's done, you can't take it back.